I would strongly consider adding international investments to your portfolio if you don't have them already. Here's why. Now, I'm very selective with all the graphs that I show you guys because I believe too many advisors will show someone a graph because they're excited about it, but the client really has no idea what it means. This is one of my favorite graphs, and if you are still confused after this, then tell me because I want to make sure you guys are enjoying this content. So check this out. I had someone who told me they retired early at 73. I said, I don't want to be mean here, but I have some clients that retire at like 50. So 73 is just not that early, but tell me more. And they said, I retired early again, meaning I did retire in my late 50s. Now I'm retiring again. I had to go back to work because I got unlucky. And I said, what happened? And they said, well, all of my money was in the S&P 500. And here's what that looks like. So if you put all of your money into the S&P 500 and you are invested from 2000 to 2009, the United States is down here. It's this little yellow bar here. It was the fourth worst performer. You actually lost money over this 9-year period. You can see right here about -3 to 3.5%. So it's nowhere to be found. Now, if this person had gotten lucky and retired in 2010, when the US was the second best performer, they would have never reached out to me. So what's the point of the story? You don't want to hope you get a good 10 years. And if you don't, you might have to go back to work. So I'm going to show you how to protect your portfolio from any risk like this in this video today. Now, real quick, in the last 28 days, you can see here, about 74% of you are not subscribed and 25% are subscribed. So if you do not like videos on tax strategy or early retirement or healthcare or where to pull money from or purpose, then I don't think you should subscribe because I don't think you'll like me very much because this is what I love talking about. If this is of interest, I invite you to subscribe so you're notified of future videos. This is a really important disclosure before we hop into today's video. Please consult with a financial professional before executing any of the strategies you see discussed today. And if you don't know me already, my name is Taublieb. I'm a certified financial planner, and I'm the host of the Early Retirement Podcast, as well as the Chief Growth Officer at Root. We have a good amount of clients that are not robots. In fact, all of them, they're humans. So they will tell us, hey, we're worried. Right now, there's a lot of tariffs. Right now, there's a lot of macroeconomic trends. There's politics shifting constantly. We're worried about investing in China or overseas in the Middle East, or you name it. And we'll say, completely makes sense. Let us show you why, if we look at the statistics, this might make sense. It doesn't mean we have to do that, but let's first understand it so we can make an informed decision. And they'll say, okay, but I really am telling you, I've got a feeling. My feeling is that it really wouldn't make sense to be overweighted to international because I believe we're the strongest country in the world. And I'll go, I totally hear you. Let me explain some logic. And then this is whether you like me or not, even excluding my personal opinion, this is what I would look at. Then let's have a conversation. And they said, okay, that's reasonable enough. And so that is the first part of what I'm going to show you today. You're going to get the logic and then you'll be able to make an informed decision. And you're going to also hear my opinion at the end of the video. Now, I'm a big believer in the behavioral aspect of finance, the psychology of how we think the way we do. Now, there are certain phrases such as recency bias or cognitive dissonance, which exist in bounds in our industry. Recency bias is a big one. And this is the idea that what's done well in the past will continue to do well. And it's because it's top of mind. It's, oh, this has done really well, so of course it will continue to do that way. There's no logic. It's the same people that go, well, if I flip a coin, I'm more likely to get heads if I keep doing this. Well, on your 10th flip, you have the same exact chances, 50-50 of getting heads or tails. But most people think, actually, if I'm 3 in a row, I'm now more likely on my 4th one to get tails if I've flipped heads for the previous 3 times. Of course, that's not true. Let me show you an example in our world. So this is a nice basic graphic done by Personal Finance Club, who make these amazing graphics. And you can see here, they explain year to date, international stock markets are up 5%, while the US stock market is about 10% negative for the year. So these are some different funds, whether it's Fidelity or Schwab or Vanguard, they all do very similar things, and you can see their performance. So it's about up 5%. Well, why is that important? Because most people will think of tech stocks, or they'll think of the S&P 500 and assume that because it's done so well recently, which once again, the exact graph that I showed you earlier was this one right here, where look at this, from 2010 to 2020, look how well the United States, the S&P 500, the biggest 500 companies, did. I mean, they did really, really well. So what people will think is just own the S&P 500, but there's a real risk to that. And I'm going to show you that right now. So check this out. These are 3 different stock market indices. Now, the green line is an international portfolio. The blue line here, and I should have picked a better color here, but apologies, balanced, so 50% international, 50% S&P 500, and then the dark blue line is the S&P 500. So what if you started with $1 million in 2002, and yes, I could pick any time frame. I just picked something because this is from a client I was talking to, so that's why I'm using this. But you could use any software to illustrate 2005, 1980, whatever you want. So what you can see here is if we're staying on the dark blue S&P 500, if they all started at $1 million, what you can see is it was actually the one in last place for a long time. In fact, look at this. I'm still following along the line. It only took about 12 years for it to just start to beat either a balanced or international portfolio. So that's a long time staying behind, but then all of a sudden it started to do really, really well. And in large part because of tech stocks who did really well. So now you could see if you were to have held out, and what I'm doing in this portfolio is saying, what if you had $1 million and you withdrew 4% every single year, which if you've seen my other videos, I do not believe the 4% rule is the one you should take because it does not apply to an early retirement. It's based on a 30-year study, not a 40-year study, which is what I use for my clients. So what you can see here is the green, which is international, it actually started doing really well. It had a really strong period. And then all of a sudden, it's actually now the last in terms of, it's still more than okay. Look at this. I mean, there's still, you can see you're right about $1.5 million. So you start with $1 million, you live for 20 years, let's call it from 60 to 80, and you now have $1.5 million. So it's not like it's a terrible thing by any means. I don't want to make it seem like that. But I hope what you're seeing right here is the most important thing is to invest well. If you have a balanced portfolio, you don't subject yourself to as much risk. And here's someone with north of $2.5 million now. They started with $1 million. They took 4% out every single year, and now they're in a comfortable spot. Now, most people, 4% out of $1 million, $40,000 a year. Well, if that's all in your 401k, you have to pay taxes and then live off of that money. So maybe you're only living off of $32,000, $35,000 a year. Look, you're not living a comfortable life with that amount of spending. So you can use the same example if this started at 2 million or 4 million or you name it. But just for example purposes, this is something that should be really interesting for you to see, because what you're seeing here is if we were to just pick one of them, you might do really well and you might be fortunate. But if you're not fortunate and you get unlucky, let's assume you retire and markets go down right away. And 2008 happens, and then all of a sudden markets are doing really poorly. And by the way, this is when your kids have college. Oh, and by the way, you're doing a home remodel. Oh, and by the way, there's healthcare and travel. I'm not trying to be annoying by doing the oh, by the way every time, but you get my point here. So what I don't want is for you to get unlucky and ever have to go back to work. Now, what I'm about to put on the screen might overwhelm some of you. That is not the goal of this video. I want to keep this simple. I want you to understand it and be able to take action and go, yep, I'm going to adjust my portfolio to X amount international, X amount S&P 500, real estate, developed, emerging, you name it. This is really important though. So I always pick and choose, like I said, because most people, including my parents, went to an advisor back in the day and said, hey, advisor, I know I need to meet. I don't love talking financial stuff because it brings anxiety, but I know it's important. And then the advisor went on to show them 200 incredibly boring graphs that made my mom basically fall asleep, which defeats the purpose of good planning. So this, you're going to see on my screen right here, this is called an investment quilt. I know it looks a little crazy, but it's cool. It's really cool. And here's why. So what this allows me to do is look at any individual year as well as a previous year time frame, such as 10 years, and see what's done the best to allow us to start to look at research more intentionally. So you can see here, for example, if we look at 2015, REITs, which stands for Real Estate Investment Trusts, were up 2.4%. Large caps, these are S&P 500, 1.3% positive. Bonds were up 0.5%. International was down 1%. You can see emerging markets down 16%. Commodities down 28%. So that was a significant year for 2015. You can see a lot of things didn't do too well. Now in 2016, small companies were up 26% versus mid-size up 20%, large caps up 12%. So you can look and follow an individual asset class. For example, If you were my client, I would let you pick one, but since we're on this video together, I'm going to pick one, and I'm going to choose commodities. So you can see here, it's down 28%, this asset class. Then it's up 12. Then it's up just about 0.7. Then it's down 13. Then it's up 7. Then it's down 4. Then it's up 31. Then it's up 17. Then it's down 10. It looks like it's either the worst or near the bottom or near the top. It's never really in the middle here except for 2024. So that's a really volatile asset class. Now, if we look over the last 10 years, you can see it was actually the worst performing one. If we go to this far right column here, let me actually make this even more clear for you guys. So I'm going to draw this on so you can see for this 10-year period here. I'm not a marketing person if you guys can't tell, but you can see here commodities didn't do well. Now, that's surprising because you're like, it had 3 really strong years. Yes, but it had many years where it did not do very well, and those weigh on a portfolio in a significant manner. Now, let's look at large companies, which historically have done really well. The S&P 500. You could see over the last 10 years, it was the best performing asset class. It was near the top most of these years, and it was the top for, you can see, 4 out of the last 10. So that's significant. The risk is, just like I showed you earlier, so I don't want you guys to forget this. If we look at right now, once again, literally like this year, it's down 10% compared to the international, which is up 5%. So the tricky thing with looking at investing is we often get distracted by this thing called recency bias. And what we want to do is always zoom out when you're in doubt. I know it's a little cliche, but when in doubt, zoom out because you can actually see what's historically been the best performing asset classes. So let's do that. Let's look at like the last 100 years. S&P 500, you put $1 in, it grows to $14,000. That's significant. If we look at the last 100 years, and I don't have the most recent document here, you can see it's only going to 2021, but still very helpful for our purposes here, 10.5%. So 10.5% is the average return. It's the same exact thing as me showing you this. This is just way prettier. So I prefer showing things like this than the last graph I showed you. The average return of the S&P 500 is 10%. What I like about this graph is you can see how often it was down 50% or 40 or 30 or 20 or 10 or just neutral. And it's allowing you to see it in a way that makes sense to your eye, which is why I'm all about showing things in a simple manner. Now, do you want to guess historically, which is actually the best performing asset class of everything here? It's actually this pink one, small caps, 8.6%. So over the last 10 years, you can see it averaged about 9% per year. This one right here, it got 3rd place in this 10-year time period. But do you remember what the S&P 500 was? If I just showed you, you put $1 in 1926, 100 years later, approximately, it's worth $14,000. That's a lot of money. But if we look at small companies, historically, you put $1 in, it doesn't grow to $14,000, it grows to $47,000. Well, what's the percent? Meaning, what's that return that we're basing it off of? It's actually based off of this number right here. It doesn't average 10%, it averages 12%. It's more volatile, but you get more growth. The best performing asset class is called small cap value. If you put $1 in, it's now worth over $134,000, which is a big difference than the S&P 500. Now, everything I've gone over in the last 15 minutes, this is what I will do with a client when we're working with people at Root. We're educating on the investment side of things so that when we're making an informed decision, it's now based off their goals. We start with the education and we start with the logic. So whether you, for example, like my maroon shirt or you hate it, that is not going to dictate whether or not you're going to have retirement success. Let's talk about, okay, what do the statistics tell us? And then we don't have to rely on that. We're just using that for our conversation. Now we'll have a conversation with a client and go, okay, what's going on right now with tariffs? What's going on right now with different economic trends? What's going on right now with price to earnings ratios? What about certain companies that you personally believe are doing really well? Do we want to add a buffer there? Maybe if we're not retiring for a few years and you're very optimistic on tech stocks, we're going to overweight that. Maybe we're actually going to just say, you know what? I don't want to think about it. I want the most diversified approach. And I'm not trying to hit it big because I've already done a good job saving and investing. I now want to retain what I've worked so hard to accumulate. So I hope your takeaway from this video is you could certainly try to overweight the S&P 500 or international, and you could be right. But the risk is that you're unlucky, and now all of a sudden, a bunch of things happen at once. And you have healthcare costs, you want to travel, kids have college, you want to spend more than you thought, and markets go down. And if you have to pull from your portfolio when markets are going down, that is really going to shift how much income you're going to have for the rest of your life. So taking a diversified approach we don't do it for the boring sake of it. It's not boring. Just like adding money to your 401k every single year is not boring. It's effective. Now, I tell everyone you're allowed to be a human, not a robot. If there's a small portion of your portfolio that you enjoy investing in a certain way because you think it might do really well, or it just allows you to have more fun, look, I do that personally. There's a few stocks that I own that is not the diversification approach. And I wholeheartedly believe they will do worse over the long term than my diversified portfolio. But I like having them. I'm a human. I think these companies might do really well. And I would shoot myself a little bit in the foot if it did really well. And I went, why didn't I have a little bit of an interest in that? Now, personally, I'm a certified financial planner. So I like having my money in a few different spots because it allows me to keep my eyes on it better. And I have a vested interest. And if I tell a client, hey, yes, maybe it makes sense to have a small hedge of cryptocurrency, I want to make sure I'm investing alongside them. So hopefully this video was insightful. If you learned something, just tell me, what was your biggest takeaway? I love making these videos, as you can tell. I would make these if you guys watch them or not, because it is that fun for me. But if there's something that you go, hey, this really is shifting. I didn't consider small companies. I knew I should diversify, but seeing this Quilt, that is cool stuff, man. Or you know what? I actually just didn't know that you could get unlucky. It makes sense to me, but I want to make sure I can prevent getting unlucky. So what should I start doing now to bulletproof my portfolio so if markets do go crazy, I'm not in a bad spot? So let me know what was most helpful below. Once again, if you want to work with Root, you can reach out to us. This is what we do for our clients, not just the investing, but the tax strategy, estate planning, insurance, healthcare. We do it all, and we love what we get to do here. So if you have any questions, you can see in the description of this video where you can reach out to apply to work with us here at Root. See you guys.